Hi everyone, welcome back to my channel. Most of us dread the word tax. We avoid it, fear it, or wait till March 31st to deal with it. But here's the truth, if you live in India and earn money, taxes are part of your life, and whether you are a student, a freelancer, salaried, or retired. Understanding tax is the difference between losing money and saving it smartly. Right now, lakhs of Indians are paying more tax than they need to, filing late or choosing the wrong ITR form, ignoring deductions they legally qualify for. This video changes that. Hey, wait a second. Before we dive into the video, make sure to hit that subscribe button. That way, you will get notified whenever I upload valuable finance content. Alright, let's jump into the video. I will walk you through the entire Indian taxation system in a simple, practical, and beginner friendly way. How much tax you actually owe based on updated 2025 slabs, what TDS means, why it's deducted, and how to get it back. The truth about capital gains tax on stocks, mutual funds, and property. Powerful deductions like 80C, 80D, and others you may be missing, and how to file your ITR correctly without stress or agents. By the end, you won't just know taxes, you will know how to save, plan, and file smarter. Let's start with the basics, what income tax really is and how slabs work. Let's start with the core question. How much tax do you need to pay in India and how is it calculated? The answer lies in something called income tax slab. Just like steps on a staircase. The more you earn, the higher the percentage of tax you pay on the extra amount. As of 2025, you can choose between two tax regimes. The new tax regime slab start with 0 to 3 lakhs as a 0 percentage and end with above 15 lakhs goes with 30 percentage. No deductions but lower rates. On the other hand, older tax regime, the slabs are different and you can claim deductions under 80C, 80D, HRA, education loan interest, etc. So which one should you choose? If you have home loans, PF, insurance, tuition fees, old regime might save you more. If you do not claim much, go with new regime and enjoy the lower rates. Small tip, use the official tax calculator on the income tax portal to compare both. Don't guess. Small recap, know your income, check both regimes and pay only what's fair, not extra. Have you ever seen a salary slip or a bank statement that says TDS deducted and wondered, wait, who took my money? That's TDS. It hints to tax deducted at source. It simply means before you receive your income, the payer deducts a portion as tax and deposits it directly with the government on your behalf. Let's break it down. For salaried, your employer deducts TDS every month from your paycheck. For fixed deposits, bank deduct TDS on interest if it crosses 40,000 per year. For senior, it will be 50,000. For freelancer or consultant, client may deduct 10% TDS before paying you. For property sale or rent above limits, TDS applies there too. But here's what most people miss. TDS is not extra tax, it's just an advance payment. If too much TDS was deducted, you will get a refund when you file your ITR. If too little was deducted, you will need to pay the difference. Small tip, always check Form 26 AS or AIS on the income tax portal to track all TDS credited in your PAN. Small recap, TDS is your prepaid tax. Track it, claim it, don't ignore it. Are you sold shares or mutual funds recently or made profit selling a house or land? That profit is called a capital gain. And yes, it's taxable. But the rate depends on how long you held the asset. There are two types of capital gain. Number one, short-term capital gain. Number two, long-term capital gain. In short-term capital gain, stocks or equity mutual funds sold within 1 year, they are taxed at 15% flat regardless of your income slab. In long-term capital gain, the stocks or mutual funds held more than 1 year and if it is gain above 1 lakh per year are taxed at 10%. What about property or gold? If property or gold held less than 2 years and it is considered as short term and taxed at your slab rate. If property or gold held for 2 years or more and it is considered as long term and taxed at 20% with indexation benefit. Indexation adjusts the purchase price for inflation, helping you save tax. Pro tip: always keep document of purchase date, price, brokerage and related cost. They help you calculate your actual gains and deduct tax legally. Small recap: time is equal to tax difference, hold longer, pay lesser. And yes, capital gains must be reported in your ITR. Want to save tax without breaking the law? Great news. The Indian tax system actually gives you the power to do so legally through deduction and exemption. Let's begin with the most powerful one, Section 80C, which allows a deduction up to 1.5 lakh. You can claim this by investing in ELSS mutual fund, public provident fund, or national savings certificate. You also get the benefit by paying life insurance premium, your children's school fees, or even repaying the principal on a home loan. By investing smartly under ATC, you could reduce your taxable income by 1.5 lakh, which means up to 45,000 saved in taxes. Next, we have Section 80D, which covers health insurance. You can claim 25,000 for premiums paid for yourself and your family. Another 25,000 if your parents are below 60, and up to 50,000 if your parents are senior citizen. So a maximum total deductions of 75,000 is possible. There are other useful deductions too, like Section 80E for education loan interest and 80 TTA, which gives you to 10,000 deductions for saving account interest. And of course, under the old tax regime, you can also get benefits like HRA, standard deduction and more. But remember, this apply only under the old tax regime. If you switch to the new tax regime, most of these are gone. Small recap: tax saving is equal to tax planning. Use all deductions that apply to you, they are your legal rights. So you have earned income, some TDS is deducted, maybe you made investment. Now comes with the big step: filing your ITR, income tax return. Even if your employer deducted TDS or you are below the taxable limit, filing your return is still important. Why? It helps get refunds, builds your financial history for loans and visas, and keeps you compliant with the law. Okay, which ITR form should you use? ITR 1 for salaried individuals with income up to 50 lakh and one house property. ITR 2 for salary plus capital gains plus multiple properties. ITR 3 if you have income from businesses or profession. ITR 4 presumptive income, that is small businesses or freelancers under 44 ADA. Visit official government website, that is incometax.government.in. Use the pre-filled online ITR form. It's simple and guided. The due dates for 2025. For individual filing, the due date is by 31st July 2025. Or with audit businesses, the due date is 31st October 2025. Small tip: file yearly. Avoid last minute errors and late filing fees of 1000 to 5000. Small recap: filing your return is equal to claiming what's yours. Do it yearly, do it right, keep proof. Tax planning is not something you do in March, it's something you start in April, right at the beginning of the financial year. Here are 7 smart habits that will help you save money, avoid errors, and stay compliant. Number 1. Choose the right tax regime yearly. Old tax regime or new tax regime. Run a quick comparison using the official calculator. Number 2. Invest monthly, not last minute. Spread your ATC investment like ELSS or PPF throughout the year. Number 3. Buy insurance for protection, not just deduction. Don't let tax saving be the only reason to get life or health insurance. Number 4. Keep a digital record of all your proofs and receipts. Use folder on Google Drive or apps like DigiLocker. Number 5. Track TDS using Form 26 AS and AIS. Make sure everything matches your actual income and investments. Number 6. Use a CA or verified tax app if your income is complex, especially important for freelancers or those with multiple sources. Number 7. Never wait till the last week of July to file. Errors, server crashes, and penalties are not worth the stress. Small recap: start early, stay organized, and plan smart. Tax is not just a duty, it's a tool. Learn to use it well. Let's quickly recap what you have learned today. Understand the tax slab and which regime is better for you. You know how TDS works and how to track it using Form 26 AS. You have learned the truth about capital gains tax and how holding periods changes everything. You discovered powerful deductions like ATC, ATD, ATE and how they save you real money. You understand which ITR form to use and why filing on time is non-negotiable. And you have picked up best practices to plan better, file smarter and save more in 2025. You are now ahead of 90% of taxpayers who wait till the last minute or blindly follow others. Action steps: review your salary, income and deductions, compare old versus new regime for yourself, file your ITR yearly this year, share this video with one person who always asks, bro, which form should I file? Don't treat tax filing like a headache. It's your financial report card, own it. If this video helped you, like, share and subscribe. More value packed money videos are on the way. Thanks for watching and see you again.